I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for July. We'll start with a recap of returns for June and then shift to an update on the Federal Reserve, corporate earnings, and our outlook going forward. Stocks picked up where they left off in May, posting another month of strong performance in June. Here in the U.S., the S&P 500 finished the month higher by 5.1% in total return, while the Russell 2000 Small Cap Index added 5.4%. Emerging stocks led the way higher in June, posting positive returns of more than 6%. Both the S&P 500 and international developed indices finished the month of June at all-time highs. On the year, the S&P 500 is higher by more than 6%, while the International Developed Index is higher by nearly 20% in total return. June was a strong month for bond investors, as falling interest rates provided a tailwind across the fixed income landscape. Taxable bonds led the way, with the index posting a 1.5% total return for the month and is now up more than 4% year-to-date. Municipal bonds also delivered positive results, gaining 0.6% in June, though the index remains lower by about 0.4% for the year. While municipal bonds have underperformed on a year-to-date basis, we continue to see compelling opportunities for tax-sensitive investors on a go-forward basis. At its most recent policy meeting, which concluded on June 17th, the Federal Reserve opted to leave interest rates unchanged, maintaining the federal funds rate at 4.25% to 4.5%. This marks the fifth consecutive meeting without a change in policy, following a total of 100 basis points in rate cuts during the fall of last year. Looking forward, the Fed continues to adopt a cautious stance on further easing, citing persistent uncertainty in the inflation outlook, driven primarily by trade dynamics and policy risks. Despite this, the Fed's latest summary of economic projections indicates that officials anticipate 2 25 basis point rate cuts in the second half of this year, and if realized, this would bring the upper range of the Fed funds rate down to 4% by year-end. In addition, the Fed now expects real GDP growth of 1.4% for the year, with the unemployment rate rising slightly to 4.5% and core inflation to remain elevated at about 3.1%. Looking ahead, the second quarter earnings season in the U.S. kicks off in mid-July, with roughly 3/4 of S&P 500 companies set to report between July 11th and August 1st. As this chart illustrates, analysts are currently forecasting earnings growth of just 4% for the second quarter, a notable slowdown from the 12% growth we saw in the first quarter. In the chart, the light blue bars represent consensus estimates, while the dark blue dots show actual results, highlighting a consistent trend of upside surprises. With valuations already elevated, another strong quarter of earnings will be key to justifying current market levels. Ultimately, continued strength in earnings and resilient profit margins will be crucial to sustaining the recent rally as we move to the second half of the year. As we close the books on the first half of 2025, global markets have now fully recovered from the tariff-driven sell-off from earlier this year. This allows us to reflect on the value of long-term planning, as investors with a clear financial roadmap and a diversified investment strategy were able to stay the course and remain focused on their long-term goals, despite short-term volatility. Looking ahead, the path forward is likely to be shaped by ongoing tariff negotiations, Fed policy, and labor market dynamics. From a market perspective, international equities continue to show strength, supported by fiscal stimulus and pro-market policies abroad. In the U.S., large-cap growth stocks have regained momentum, while small and mid-cap companies may offer the potential for upside surprises given lackluster expectations. Finally, bonds should prove to be a worthy diversifier and income producer for investors, with interest rates comfortably above the rate of inflation. So that's what we have for this month. Thank you for watching and have a great day.